Cool. All right. Well, we are back in business today. Thanks, everyone, for solid day one of TokenizeThis 2024. We got RWA Market Movers, and we call it that because we got some heavy hitters on stage right now. To my right, we got Thomas Cowan from Galaxy. We got Mike Bucella of Neoclassic Capital and Anthony Bassili from Coinbase. Maybe we'll just go down the road. Tom, if you want to start, and just a little intro about yourself and overview about the firm to keep it easy.
Happy to. I know we have a hard job ahead of us because we are standing between you and happy hour right now. So I think we'll do well, though. I'm not worried. So I'm Thomas Cowan. I run Tokenization at Galaxy. Before that, I was at Paxos, helping run their PayPal stablecoin. And then I was at Ripple before that and started down this rabbit hole at the Fed on their CBDC team. And Galaxy, a quick overview, it's a boutique investment bank that focuses specifically on all things crypto. So about 500 people, has a sales and trading division, investment banking, and then asset management as well.
Mike Bucella, managing partner of Neoclassic Capital, a relatively underknown, recently public investment fund. We invest in emerging early stage crypto and crypto related companies with a focus on Asia, focus on the application layer so we can get some users. Previously was a partner at a firm called Block Tower Capital, which had multiple strategies, hedge fund, credit, which we can talk about a bit more. And then spent 10 years at Goldman prior to that. And I'm the generalist pleb between the two experts here.
Don't give me too much credit. Yeah, Anthony Bassili. I'm at Coinbase Institutional. I run tokenization and the asset allocators business. I spoke earlier, so I won't spend too much time on repeating what I said, but generally speaking, we provide infrastructure across our centralized crypto ecosystem, but also Web3. That includes blockchains, wallets, payment, SDKs, identity, and other things that we think tokenization is going to utilize. Glad to be here.
Beautiful. Thank you, guys. All right. To kind of hop into it, Mike, I'm actually very curious. Sorry to throw you on the spot there. The recent.
That in the middle, so that wouldn't happen.
Yeah, the recent launch of the fund. Very curious what you're looking at specifically in like the RWA space, tokenization. You mentioned the application layer. Anything specific that the crowd can kind of keep an eye on trend-wise?
Yeah, it's an interesting question. So part of our application focus is financial services. The other side being consumer. Yeah, I mean, the RWA space, it's kind of evolving. Anything that creates a organic bridge between the off-chain and on-chain market. So I've always viewed, basically the rationale or the reason that assets will move on-chain is because of arbitrage, right? There's some risk in the market that's mispriced, and so, for example, nobody really cared to tap into MakerDAO's treasury until there were 4% credit lines when the market was trading for that type of product. God only knows, but there was no market for it. And then everybody jumped on board. And so there was an arbitrage in cost of capital. On-chain capital ebbs and flows with interesting product launches and obviously token incentives. I think from my perspective, there's the very simple, or not simple, I should say. There's the path of retail adoption of on-chain finance, or RWA, which is probably going to be much more fast and furious, a bit more unregulated. A lot of our focus, again, my business partner, much more intimately familiar, but there's a lot more of this going on in Korea, Japan, Southeast Asia. The institutional side is going to be a much, much slower, much larger onboarding. And so I think the idea is to invest in both of those, sort of back both of those horses. I think the token economics and incentive models will continue to prevail in retail land. And I think it's going to be a much more arduous process, much more regulatory forward process for the larger scale stuff. And so honestly, from my perspective, as an early stage investor, looking at things super, early on in their life cycle, it's going to be harder to invest in the latter, even though that will have a larger addressable market, simply because we're not a growth stage focused fund manager. So we'll see. I think it's hard to say specifically because things evolve very quickly. I mean, my first light bulb. I always thought finance would be on chain, but my first light bulb was when I was a mentor on the CDL accelerator and I met Sid from Maple. and that was early on in their life. And I said, okay, this is really interesting that people are pushing forward and building product here. And then we just kind of went deep, and we invested in a lot of RWA protocols or lending protocols back then. It was just a very different market, and ultimately that didn't end up too well. But yeah, it's evolved, and there's a bunch of different ways to be successful. From an investor standpoint, though, from my fund, it's focusing on the things that are probably less likely to be the massive institutional adoption.
Yeah, can I just add to it? So I think one of the things I didn't really touch on earlier was this concept of on-chain solutions, which is a business that I formed inside of Coinbase, which is focused on tokenization, but it's actually focused on how do we bring solutions to the on-chain users. So that's the issuers, that's the dApps, and that's the investors. And so kind of helping to coach them to utilize the infrastructure stack. A big piece of that is maybe thinking like an early stage investor, saying where are they in their life cycle? Are they ready for compliance? Are they ready for KYC? Are they ready for licenses in whatever jurisdiction they're in? Or are we operating in a world of just private market exempted type of offerings, in the case of things that have to be in that structure? And I'd say looking across the landscape, as we've rolled out this business, this solutions business, focused on this particular vertical of how do we bring real world assets on chain, inside of the crypto ecosystem, what I see is the vast majority of the applications are very early stage, right? And they haven't yet defined who they're catering to. They're trying to figure out, are they an institutional shop or are they a retail shop? They're trying to figure out, do I go licenses, do I not? They're also, as I mentioned, they're trying to build their own issuance pipeline. Some of them pivoted from being a software layer to being the underwriter over the years, right? And it's like a complete change of business model. And it speaks to, being an early stage company. So I think from my vantage point, we kind of see the same question, right, across the ecosystem of where are you in your life cycle? And the mature ones, right, the mature platforms are some of them are 5-6 years old, maybe older, and they've gone through multiple regulatory regimes and licensing, and they've done all the work to get to that point. And they would be in their the Series B, maybe later stage now. So it's good to see that the market's getting to that point.
No, great perspectives, Mike. Thanks for sharing about what you guys are looking at, Anthony. On the on-chain solutions, for sure, is a key need, and I'm glad you touched upon that here. Now, Thomas, you sit in a pretty interesting position now also. You spent some time setting up All Unity as kind of a tri-joint venture with a couple other firms and Galaxy, if you want to kind of share what that's all about. The onboarding, what the real goal of that product will be, I think that'd be kind of huge to keep an eye on.
Yeah, happy to. So kind of building off the idea that you have to start small, and it just takes forever, especially in this space, to really get that momentum going. About a year ago or so, we began the process of partnering with Deutsche Bank and Flow Traders to launch a stablecoin in Germany, and so that we announced in December that we're forming a startup that we're incubating that's now pretty much on its own now, based in Frankfurt, and they're going through the licensing process to be able to launch a fully backed fiat stablecoin based in Frankfurt. And just because of the timeline, it'll likely be mid-25 once they get the full approval to be able to launch. But I think what's exciting about this stablecoin is really two things. First is the regulatory clarity, as we've already kind of touched on already. Is one of the biggest barriers, as we know, and that's been something we've talked about a lot today. And the other thing too is having the partnership with the asset management arm of Deutsche Bank means that they come with an amount of credibility in the region that is kind of unmatched. So what that means is that when this stablecoin is out in the market, it just means that you have TradFi institutions and traditional corporates that otherwise aren't thinking about crypto would just look at this as, oh, this is the new version of the euro. This is a euro just like all the other networks that you can move a euro along. It just is much faster. It is much cheaper and just works. And so from that project, really, from a Galaxy point of view, is the thing that brought us on board. I mean, it's excited about it because we looked at it and said, okay, this is a great way to bridge that chasm, going from this crypto world that is unbelievably volatile to suddenly seeing a use case that is kind of frankly boring, and that's the idea. Is you want to get there as fast as possible, so you don't think about it, and it just works. So that's kind of where the project is and the idea behind it. And we're quite excited to be able to work with others and build out the partnership as it gets closer to launch.
Cool. And we just talked before here about retail, institutional. Is there a target use case for that, or where the product will actually live? Like, what kind of platforms do you want kind of interacting with it?
Yeah. So back to kind of your point earlier about how you have to start small. While the end goal may be to work with large institutions, you really want to start with the crypto native use cases, just to ensure you have liquidity, ensure you have developers using the product, and ensure that you kind of build that flywheel so that when a large company does want to onboard and does want to start using this product, it already has the support of the rest of the industry to be able to get there. So answer is short term, we're really focusing on crypto. Long term, we see this as becoming, one of the default ways that a euro is moved and stored globally.
Nice. Okay. Makes total sense. So this is the onboarding mechanism, let's say, on the stablecoin side. Anthony, we talked about that earlier. Thomas, we're talking about it now. Mike, I like the perspective on really what to look at to fund right now. Aside from that, what would the trends that you guys are looking at? I know we just had a trends panel, but what kind of trends are you looking at beyond the stablecoin side, the money market side, that's kind of the low-hanging fruit? And what's really going to catch your eye, even in the next year, but it could be the next 3 years? What do you think will be the kind of the bread and butter? Without giving away your position, Mike.
I'm happy to jump in with that. I think on the previous panel, they discussed how there are a lot of different companies who are focusing on, tokenized treasuries, and that's exciting. But what I think is, what I'm really excited to see over the second half of 24 is only a handful of those are really going to be the ones that grab adoption. But all those other companies are learning how to tokenize debt. They're learning how to take these TradFi financial products and get them on chain. And all the VCs, through the funding process, are also learning how that actually works in this new world. So that talent and that capital isn't going to disappear. It's just going to move down the risk curve from traditional government money market fund down to other debt products. So at least on my end, in the short term, over the next 6 to 12 months, I think that is going to be a major unlock where we really see people shift towards other debt products in the short term.
Yeah, it's just insane. Like, it's arbitrage. Again, it's, do I hold stables backed by, treasuries? Do I hold stables backed by basis trading? Like, Athena was probably the biggest growth mechanism for stables. But all this is, so I would say for every, Athena, it's 90% on-chain existing capital moving from project to new project, and it's maybe 10% new capital on-chain. And I don't know those metrics, and, I could be wildly off, but I think that's roughly accurate. And so, yeah, they got away with, and I'm a fan of the team. I'm an investor through a fund. I think what they did was brilliant. It was, here's this, basis trade that exists. We can express all of the risks in that. We can tie it up into a stable coin. So, and we can have this, native token that collects fees as any management company would. And we're giving people, depending on the spreads, in any given time period, a substantial return on their holdings, and staying in a stable US dollar denominated delta neutral strategy. That makes sense. That's interesting. That's better than the 5% you're getting in any money market backed or treasury yield product. So the trends I think are going to be more interesting. Now, whether or not that is able to be retained, and it definitely won't happen in the US onshore. You see more creative, interesting ways for people to generate interest in stable coins or credit products on chain. That's going to happen mostly offshore and be looking for offshore users. And those users want that. They want alternative, products. In the US, we're spoiled. We have a ton of alternative products, even for the retail base. In the rest of the world, there's a reason that the highest trading pair for most crypto is the Korean won. They don't have much, right? They have the Kospi, and they've got crypto. And there's not a lot of interesting debt products. There's not a lot of interesting strategies, and the average retail investor doesn't have access to most things because of capital controls. So I think if you can continue to target audiences that don't have an alternative with something unique and interesting that is an alternative with hopefully low risk and at least good risk-adjusted returns, right? So if there is a substantial return, the risks are disclosed and people can feel, somewhat comfortable moving into those things. That's great. I think the explosion in private credit and traditional markets is very good for our industry because, one, a lot of these private credit assets and managers came up in the last decade, and I think there's going to be a lot of damage done in that market. And I think if everybody's screwing up, at least we have a better product, right? So, I think, the world of credit and particularly private credit, there's going to be a lot of pain in that market, in the traditional world. And I think people are going to say, hey, because cryptos had to be so, careful about what they do, they've actually outperformed the long tail of credit managers. And it's a more simple product, it's a more streamlined product, and that might be a next kind of onboarding segment. I never thought about that till this exact moment. So that could be, again, you can ask questions if it didn't make sense, but.
Makes sense. I think you said two words, risk adjusted, which I think are prescient to this. So also everyone just needs to understand that there's kind of like different form factors in this conversation. There's the US and the non-US. You have very different things happening across the two, mostly because of regulations, if not all. Two, also because here we enjoy a lot of options and outside we don't, as you talked about. There's also there's real world assets that are tokenized and brought on chain really with the intention to kind of redistribute them to US investors under an existing regulatory regime, following full KYC and everything else. And generally, when we talk about tokenization, we're almost always talking about that form factor, which is fully KYC, OFAC compliant, registered, licensed individuals and platforms bringing real assets into a format they can sell. Then there's like other stuff around stable coins, and stable coins continue to evolve. Most of them that we know, USDC included, are, and yours that you guys are spinning up, are going to be fully backed under audited, licensed, regulated intermediaries. And holding T-bills and things like that. And then if you go offshore, you have stable coins that have a little bit more flexibility in terms of what they hold. It goes so far even to say that there's a stable coin like Makers, which is DAI, that holds a blend of crypto, real-world assets, and T-bills. And understanding that from an investor's perspective, that you can have a real-world asset effectively that is a stable coin that moves with the fluidity of crypto around this ecosystem is a really big unlock. Leading to things like Athena that become basis trades inside of a stablecoin. Big question is how long will that last? It's a really novel use of the market structure. It's a really great way to take advantage of big arbitrage and then deliver that exposure to investors. But it does come with other risks that investors have to be just wary of and understand what's happening in these products. One really important thing is like no one's fiduciary duty or obligation to go and understand what actually is happening inside the products goes away when you tokenize something. It actually gets increased because it's a new layer of technology that has novel, new applications and structures behind it. So everyone in this audience who's thinking about this, I'll tokenize it and it becomes less risky. It's not true, right? Your ideal state is to tokenize something, keep it in the same level of product riskiness, which means that I understand what the exposure is. My risk-adjusted returns are the same, but I've improved functionality because now I brought it on chain in a more transparent, more liquid format. We're trying to get to that level of clarity across the industry. And this is something that when we talk about tokenization, we focus heavily on that piece, right? Understand the risk inside the products, issue them in the right regulatory structure, bring them on chain through the right distribution venues, and hopefully they have more utility. And we think that's possible and it's actually absolutely coming. But while that's happening, there's going to be a lot of exploration. There's going to be a lot of innovation, and that's actually, the innovation is the thing that pushes us forward, right, in this industry, that allows us to kind of explore areas of market structure that we hadn't explored before. So just want to make sure that we kind of level set on the different form functions there.
Yeah, and this conference, STM, Coinbase Galaxy, is very much about pushing the market forward towards institutional adoption. So that is the key function of what groups like this is all about. But I always like to reflect back, some of the largest onboarding mechanisms for crypto has been, we'll call it experimentation, full-on degen products, where the risk-adjusted returns have been atrocious. But those are onboarding agents. And that's why you have to, again, when we think about funding certain things, you have to fund some of the crazy ideas. And some of them aren't crazy. They're kind of bad ideas that work, right? Like, UST, horrible risk-adjusted return. You have an algorithmic stable coin, you're getting your maximum return is 20%, right? And if it all falls apart, you're zero. Luna was a much better trade. Luna, you potentially were, infinite upside, right? There was an untapped FDV on Luna, and your downside was zero. So at least there you're getting a proper return for your dollars. I think, a lot of, for example, the most recent onboarding mechanism for the industry, meme coins. And, I'm not going to sit, I didn't do a whole, Medium post on why meme coins are, the next social network. And, just as quickly as those went up, they got pulled back when memes fell off a cliff. And that's kind of the shitty part of our industry is that people, will jump behind something, momentum's there, and completely abandon it when it's not. The one thing I will say, RWA has gone through enormous cycles, and most of the players, the people at least I've known for a long period of time, have never had an inconsistent message. But yeah, so meme coins, again, probably a terrible risk-adjusted return, but has onboarded a bunch of, normies, right, traditional off-chain dollars, and that eventually flows through into the consistent stack of on-chain capital. So every cycle, there's really cool stuff, really interesting stuff, really progressive stuff that pushes us forward as an industry, but there's a ton of degen garbage that onboards a ton of capital, cycle turns, we probably retain 50% of that capital. And so I don't mind, listen, we always come up here, we say, what was your pitch? Well, I spent 10 years at Goldman Sachs. Because why do you do that? Because you have to credentialize yourself if you're in this industry, because people see the headlines. People see, oh, you guys are a bunch of meme coin, cowboys and cowgirls, right? But it's experimental financial products is the foundation of Wall Street. And you could look at 1980s and the 90s and look at some really funky stuff. And even look at today. The 2021 SPAC cycle was absurd. And 90+% of them are trading well below, par and probably close to a zero. But some capital stayed there. So there was some change in that industry, and it's getting better, I think. So I always like to go back to the fact that it takes really funky, sometimes really ugly stuff to get people to move, because we all tout on-chain treasuries at the level they're at, but that's not, everyone's chasing the same on-chain pools of money for those projects. How do we get another, the next million users on-chain? You got to do something really different, really unique. And in the meantime, I appreciate the effort from the Coinbases and the Galaxies and the Avalanches and the Maples and everyone else in this market who is pushing forward on a very institutionally aligned strategy, but also keeping an eye on, like you said, keeping an eye on what's happening in the experimental side of the market.
One thing I'll also add to that too is I think for a lot of people who came from maybe TradFi or big tech, the way that they fell into this industry is through the meme coins and is through them kind of spending the weekends learning about this technology and then being convinced by it, realizing its potential, and then ending up jumping into it and making their career. And so I think without that crazy end of the tail situation, you don't end up pulling in the people who actually end up building the product.
It's failure to start. The biggest step is just putting your first dollar on chain. And once you're on chain, then it's okay, I'll screw around with these meme coins, but hey, I'm going to put some money into a I plug in Maple, a Maple pool, right? Sid, wherever you are. You're not even here. Forget Maple. But it's really the biggest hurdle. Even 7 years full time in this industry, every time I put incremental capital on chain, it's a little bit of almost a hesitation still, which is kind of crazy to me. So I get why folks that are new to this industry. But again, I think it goes back to, I think we're all roughly around the same. But I started at Goldman 2 weeks before Lehman collapsed. So I always have this risk mindset in the back of my head. So I always second guess every single thing. This new generation, I mean, they grew up in a zero interest rate environment. They grew up, what is it? Everything up? What is it? Everything up?
Up only?
Up only. Jesus,
to the moon?
That was terrible. Up only. Yeah, Safe Moon. Remember Safe Moon? So there's going to be much less friction with the next generation, which I'm pretty excited about, because that probably aligns with what we're all doing and the timeline that it'll hit. But yeah, I always like to put people back into the mindset of the degen stuff, sadly, but also kind of nice, is the thing that has onboarded the vast majority of new money on chain.
Yeah. Sorry if we're just going to keep talking. Make your job easy.
Rip it, go ahead.
So I think like if I look across the landscape, we're working with maybe I'll call it like 300 different applications that are building across multiple chains, all for different versions of financial service products. And again, like this is outside of Coinbase's normal centralized boxes, all on chain, on Base, and on other networks. And as I alluded to in the last conversation, I'll repeat it. What we're trying to build is a multi-asset, global, multi-jurisdictional marketplace that allows for the issuance, and I mean this like democratization of issuance capabilities to be available for private small businesses all around the world. And when we talk about our mission at Coinbase, which is to increase economic freedom around the world through open financial systems, this is exactly what we're talking about, which is we know that finance spreads democracy and freedom around the world. This has been proven now for hundreds, some would argue thousands of years. Now the next phase of this is to take us out of probably the super mature banking structure that we have to a layer where products themselves, financial services themselves, all operate on a global layer, right? Not in silos. And that's what we're building. So when we look across the landscape, the vantage point we have is, okay, who's building what where? And so all of these early stage companies that are building are trying to figure out a business model to bring financial services, whether it's lending or credit or derivatives or perpetuals or reinsurance or carbon credits or just project finance in general. They're trying to retool the capital markets so they can go and build a business that lends or invests or makes things available to people anywhere in different jurisdictions. Now, each of them, of the 300 or 400 that we talked to, are having to build their own product pipeline, having to build their own distribution, having to follow their own legal regulatory regimes in those jurisdictions. And I would say they're all doing phenomenal work, right? This is a global phenomenon that's happening. Meme coins is a little bubble that happens. NFTs were a little bubble that happens, throughout the cycle. DeFi, lending pools, is a little bubble that happens that brings capital in. Once that capital comes in, it sticks around. It gets then rerouted to what we expect to be real use cases, real lending, real investing into real projects that happen for people who generally can't access financial services from the traditional system. And that's really who we're targeting, like other 2 billion people who just don't have access, or they're in parts of the world that have absolutely terrible governance, right? They are in parts of the world that are ravaged by inflation, where if you're walking the streets in Venezuela, you walk around into the black markets and people are like, crypto, crypto, crypto. Somebody gets their paycheck and they go buy a can of beans because that holds its value better than the dollar in those jurisdictions. That's real. So they need an option to be able to convert their fiat burning money into something that's a can of beans or something that's digital. And this is happening with this infrastructure that we're building. So don't get lost in the meme coin craze because it's a part of the natural cycle of innovation. But the result of it is new financial products on a global infrastructure layer that allows people to invest, hopefully in the way that helps their lives.
And that's the real J curve. Like what you guys, again, I go back to what you guys are building is really the massive J curve of on-chain capital because it's institutional and it effectively on-chains the banking system. That's the big. If Coinbase is ever doing a seed round, I'd love to participate. If you guys,
we're going to bring back a bridge.
I like what you're doing.
One question I actually would have for you is, with that vision, I think Coinbase has the potential to disintermediate a lot of the traditional financial system, but at the same time, to get there, you have to, in many ways, embrace that traditional financial system to be able to onboard those users. I'm curious how you view that balance. I have an answer for Galaxy, but I'm curious how you view it because it's kind of a dance between the two.
Well, I mean, we partner with as many financial institutions that want to partner with us today. So we've integrated with Aladdin at BlackRock. We are working with almost all of the ETF issuers for Bitcoin across the space. We operate in 100 countries. We are the back-end infrastructure for a lot of institutions around the world that are offering digital asset, stocks, bonds to their clients. And then who do they buy crypto from? They come and trade it with us on our exchange. And so we're the back-end infrastructure for so many, like thousands of institutions around the world today. And we serve that piece of digital assets. Like, are they going to use us for digital assets? So I think the answer is like we're going to integrate with everybody. We're probably going to integrate with all the banks at some point too, so that they can serve their customers within their ecosystem if it's related to crypto. Now, as this evolves and the product lineup grows and licenses grow and the maturity of the overall industry grows and regulatory regimes start to evolve, there's good signs happening in the UK and Europe and Singapore and Japan, Hong Kong, right? All over the world, you're seeing regulators and policymakers lean into digital assets as understanding that it's the right format for us to start to produce financial products in. The US will get there. So I think we integrate with everybody, and we continue to build our business, which is to serve our customers in Web3. A key differentiator, though, is if you talk to Brian Armstrong, and his vision is to take Coinbase in its current centralized form and actually bring it on chain. Like we do want to run the vast majority of our operations on a blockchain. And that's what we're doing with Base, is we're starting to evolve from being a fully centralized institution to being a fully digitally native institution. The challenge that most legacy banks and others are going to have is to operate with fully on-chain customers, fully on-chain products, fully on-chain institutions. We know how to work with DAOs, right? A DAO is a decentralized autonomous organization. You're starting to see regulators around different parts of the states, like Wyoming and others, and different parts of the world, like Marshall Islands and places like that, like establish clear frameworks for a DAO to be a legally represented entity, right? And this is a big deal because it allows networks of communities to come together on chain, form an entity that has legal status, protects people's liability, and lets them go and do whatever they do, build a business, or something like that. So we know how to work with those clients. That's a muscle that we're building as a firm. And when you think about legacy financial system, they're just going to take them a long time to get there for some of those things. So I think the answer is we're going to connect, we're going to integrate with both sides, the futurists, right, and the legacy structures, and we want to, but our path is forward, not backwards.
Thomas, did you have anything about the Galaxy side on that?
Why, thank you for asking. No, very similar sentiment there, where I do see it does require a bridge. The thing I would also add is, while Galaxy is a crypto-focused investment bank, you can almost forget about the technology because the services that the bank delivers is tech agnostic. You look at the sales and trading side, you're still going to have customers want to be able to work with you for advice on buying and selling different financial assets that we can offer. And you're still going to have companies that want to purchase other ones come to us asking for advice to do so, or having companies that want to raise another round and looking to raise capital also come to us as well. So in many ways, even though we are crypto focused, the service that we provide is still tech agnostic, and that is something that we know will continue in this transition that we see in the longer term.
Cool. No, I think we get it on the infrastructure side here. Look, totally agree. We need more exciting products. I think the industry years ago started that way, in a way, trying to go straight to alts. We know now we need to see the money market flows. It's all good to see a few extra million come in, 20 million, 50 million here. What do you guys think of like tokenized ETFs, tokenized stocks? And not from like a new investor access perspective, but purely from we need to get traditional traders hyped up to join the industry. And we track at Security Token Market tokenized stock data. We've been tracking it for a while. I won't make numbers up. We saw a handful of like 20% plus spreads on Apple stock versus a token version. So I'm very curious, Mike, you've been talking arbitrage, Anthony, Thomas, we've been talking kind of infrastructure side, like what does it take to get flow traders involved, to get other market makers, other trading firms involved, just to get more liquidity and more volume in the space and really all these, different blockchain-based assets, get them swapping hands?
I'm less familiar with them. I mean, I just remember synthetics, and that was a big headache. And I know that people are working on this today, but it's a big regulatory question.
Do you still have money stuck on V4?
Sore subject. I have money stuck everywhere. So I would say, I don't know. I mean, listen, to the extent that, quant models and machine learning run the vast majority of volumes today, that's great. Otherwise, let people sleep. I mean, just let the markets be 9 to 4. We don't need every market to be 24/7. But I think, that's half joking. In a future where it's, again, primarily, like even now, most volumes are driven by quant models and ML-based and rules-based trading models. yeah, I think arbitrage will keep the weekend activity there, but I don't necessarily know how much we need those types of things. I think what we can do is put all of these assets on chain. I think that is something that should absolutely happen, but I think having guardrails or having market hours, isn't the worst thing in the world. I never really thought through this. I don't know why I decided to step up and speak first, so I'll let one of you guys.
Can I jump in?
Yeah.
So one of the, if you like go like super fast forward and you think about the future of, like if you think about the way that crypto works is you can customize portfolios through smart contracts. The wrappers are all smart. They integrate with each other. I can move assets around, post as collateral. I can borrow against it, all permissionlessly and seamlessly. It's amazing. As a former portfolio manager and people who are all like in the same boat, right? And anyone in the audience who does today probably manages money, trades, right? When you go to your 401k, the more complex your strategy, the harder it is to do well, generally speaking. And there's a lot of things that could go wrong. And if I had a world where I could automate my trading instructions and I could automate rebalancing on a different schedule, or I wasn't beholden to the product that XYZ asset manager created with whatever's inside of it, it's a really good world. So all that to be said, the architecture of crypto is the ideal architecture for all financial products. It's going to be hard to bring everything into that space. And it'll take us a long time because of the regulatory environment. But the architecture of crypto is exactly where we want stocks to go. We want private credit to go. We want bonds to go. We want all that stuff to be in a digital format that's composable and that I can utilize across permissionless applications. So stocks on-chain, sure. Now, are they going to come fast? I don't think so, right? I think it's going to take a while. There already are stocks, and for some reason they keep putting the same 4. So they keep putting the FANGs on chain. Each of those platforms is building under a fully regulated structure the ability to buy tokenized stocks. The structure of it, though, is typically, how would I describe it? There's a couple new layers that are added where you're holding the stock at a custodian, there's a trust that's there, you tokenize the trust, and then you offer it either onshore or offshore as a perp. Effectively, at some point, they just become derivatives, of the underlying stock that you held. The perfect world is to find the next company who goes, I'm going to issue this stock, which is a capital raising event, on a public blockchain as a digitally native instrument in the right regime where they allow me to do this. And there isn't this off-chain mirror asset, that's sitting in someone's custody somewhere. So when we get to that world where we can do that in the right regulatory structure, we're going to see the public equity markets explode on chain. I think until then, when you have the mirror structure, it's going to be a lot of slogging along.
Yeah, I would just add the timeline on that. I think for stocks, especially because of the regulatory environment, is going to be the longest, I think, and also because the size of the market. I think regulators generally are more lenient when the market is smaller and the impact on the global economy is smaller. But when you start talking about the U.S. Stock market, that is just the risk there is so high that they're understandably going to crawl their way towards that long-term goal, which we'll get to. I just think it'll be kind of farther off compared to the other financial assets that will end up on chain first.
And when their buddies at the financial institutions are at risk, they're slower.
That too.
Yeah. The one I forgot. So the other part, I was one-dimensional, just thinking about people trading stocks. My response, your guys' response was very good. I didn't think about the settlement time for trades. So that probably unlocks a lot of liquidity into capital markets. So I could see that being very impactful. So going from T+2 to T+0. I mean, that reduction of operational risk, that reduction of risk in the full stack of capital markets probably unlocks a fair amount of liquidity, maybe slightly impacts cost of capital, and probably has pretty big implications for banks and asset managers alike. I would need to think through it, but that's something that I think is substantial. Yeah. Thought bubble that popped out of my mouth.
I like that. One additional point to that is the fact that if we were to go to real time where there's, markets are always open, putting my Fed hat back on, that would kind of break your head because you need a time when the markets aren't trading to be able to, when banks
Take people's
fail.
gold.
Yeah, sure. Tokenize gold. I like that.
I said take people's gold.
Take people's gold.
Yeah, that too. But yeah, no, I'm really like banks do fail. That happens, and that gives the weekends give time for the Fed to be able to kind of figure out a way to buy them and solve that problem before the markets open on Sunday night in Asia. And you just, from a regulator point of view, you do need that fail-safe to be able to ensure that they have some lever to be able to pull to ensure that they can keep the markets functioning when they are open. Otherwise, I think you'd see, unbelievable fluctuations.
Yeah, that's smart. I forgot you worked at the Fed. I retract my statement about being friends with the financial institutions. I did not mean that.
I love it. No, I was thinking from a purely selfish perspective, like everyone, lost their minds when the liquidity fund cohort hit $1 billion a couple of weeks ago in AUM. Like if we could hit XYZ trading volume purely off market makers looking at different spreads on stocks versus the tokenized version, like that could do wonders just to get new interest, just from traditional players or crypto native players now saying, damn, I can make markets in this space too. Whole different unlock. Listen, we got a couple minutes left. I think the most curious thing from my perspective, how do you guys collab? Is there a collab? Is it more competitive? Like, how should everyone, here kind of think about the three of you guys up here on stage?
I'll let Galaxy start.
Well, I was trying to think of all the different ways that Galaxy and Coinbase work together, and I feel like we're both big enough companies that I actually don't know all of the different divisions and all the relationships, but I do know that it's quite close, and at a high level, you need companies of this size to work together to be able to bring on, the next large companies on board, and to be able to support, the smaller startups that do want to be able to, for example, if they want to bring in capital and be funded in USDC, you need a company the size of Circle that is comparatively trustworthy in the space to be able to enable them to have the tools to be able to build their startup. So without the bigger companies providing kind of that structure, it means that the industry won't be able to move forward as quickly. So from that point of view, I think it's very much collaborative and very much, if we're all work together, the market gets much, much bigger.
I would say if you guys are willing to put some capital up and let's start funding some of these projects.
Oh yeah,
that needs
only
big
degens,
strapping.
Strictly degens, nothing else.
In that case, I'm in.
Perfect.
No, but seriously though, Galaxy, they custody assets with Coinbase. They're a trading partner with us. We do staking with Galaxy. We do a lot with Galaxy. So in terms of collaboration, I think you're going to see, again, crypto is the great onboarding. As their business has grown, our business has grown, and we've found success together. And we're going to embark on whatever the next wave of this is, right? As this market matures for tokenized products, maybe it becomes, a market maker relationship that steps in the middle, and we can all together support the infrastructure for that ecosystem that brings liquidity to the products. Yeah, it'll take time for the market structure to grow. This is the thing that we kind of maybe we'll leave you with this, which is the market is still immature. The crypto market's very mature. We're 4 cycles. DeFi, other things have been through massive volatility events and sticks around. It's working. The networks are working great, and people are building, right? Millions and millions of people are building. 100 million people now hold stable coins, 400 million wallets. Think of this like the computers, like we had to give computers in the 90s for people to access the internet. Now we're giving wallets to people to access the blockchain. So 400 million plus people around the world have wallets, and people are building all kinds of new websites called apps or dApps if they're decentralized. And that's the phase of the market we're in right now. And I think financial services are just beginning to really turn on in that ecosystem. So there's going to be a lot of room for collaboration.
Yeah, and I think once it's hard to keep up with these emerging companies, Galaxy, Coinbase. But once you guys get to a certain state, I'm happy to collaborate with both of you. We former shop client, happy client of Coinbase. Always know the organization, throughout. Fantastic organization. I feel like Donald Trump. Fantastic organization. All right. Galaxy I'm apolitical, please. And then Galaxy, obviously, we've known forever. Shared trading color, but I do think everyone spends way too much time on Twitter and not enough time speaking with each other. So as much as collaboration, business to business, the person to person collaboration, like that to me is the signal amongst a ton of noise. And between Twitter and Discord and Telegram, communication is. You're awash in communication, but very little collaboration gets done through those venues. So I just feel like I've made it a point to try and decrease my time on Twitter and increase my time on phone calls or meetings with folks. So When we had an office in BT, we had an office in Brickell Key. I would do morning walks with whoever from the industry would want to do them. I'm in Miami, I'm in Sunset Harbor. Anyone wants to take a walk around Sunset Harbor that's building or doing something interesting, that's my mode of collaboration.
Beautiful. Well, this is it right here on stage. We'll look out for the JV to come after this one. Listen, RWA Market Movers, everybody. Anthony, Mike, Thomas, thanks so much for joining. We got STM Insights right after this, I believe. Don't quote me on that one. But I'll be front row watching if you guys want to get some data insights from our team.
Thank you.